Hello, everyone. Welcome to the 5-year retirement tax window webinar. Thank you for joining us this morning or this afternoon, or maybe later on if you're watching the recording. What we're going to be covering today is really the key of this tax efficiency window that is between when you retire and when your RMDs begin. You see, most people don't realize that um, once you retire, the likelihood of your taxes actually increasing at some point is relatively high. And so we'll talk about that. Why does that retirement tax trap exist? What are the key levers that you can pull or adjust now that lower taxes later on in retirement? How to define what that tax window is for yourself, and then a self-assessment scorecard so you can make sure that you're utilizing those levers. You know your personal tax window and you're avoiding any potential tax traps down the road. Now, why taxes tend to increase in retirement is strictly because required minimum distributions. For the last 20, 30 years, most pre-retirees have been contributing into traditional 401k plans or individual retirement accounts. And with any of those qualified accounts, once you reach age 73, for most of you, but for some, it's age 75, you'll be required to distribute or take distributions from those tax deferred accounts and pay taxes on those withdrawals, whether you need the funds or not. And so RMDs only increase each year after they start, again, at typically 73, but for some of you, 75. And then what happens is you're receiving Social Security by that time. So that also becomes more taxable, up to 85% of that being taxable. Between those two income amounts that you may not even need, if you're above a certain threshold, you're also now triggering Medicare penalties, which is another form of tax. And those typically don't go away unless you have a severe dip in income in future years. And then, not to mention, you may be pulling from other tax deferred accounts or taxable accounts that are increasing your taxable income from a tax return standpoint. So all of those can create what we see frequently as an increased tax rate compared to what your tax rate might currently be if you're employed. And so what we really like to do when we're building a retirement plan for someone looking to retire in the next 12, 24, 36 months is we want to identify if they have a tax window, and if so, what the length of time that tax window exists. And so that tax window is essentially the time that you stop working and stop taking earned income until that period where things like Social Security start and required minimum distributions start. Typically, this is the window of time when your taxable income is lowest. And so we want to see, okay, out of all the tax levers that we can pull, which ones make the most sense for you specifically? So, what we can do is when you have this tax window, when you know that period of time, let's say from the period of time when you retire until your required minimum distributions start. That's usually, let's call it, if you're retiring at 65, your RMD start at 73. That's a great 8-year window. For some, if you're planning to take Social Security income right at 67 at full retirement age, you still have a tax window. It's just shorter. It's just 2 years instead of 8 years. And so what we still want to do is how we take advantage of that is essentially you have the option of when to withdraw funds from your IRAs or your 401ks. If you're doing Roth conversions, again, you can decide how much you want to convert, and you get to decide, okay, how much tax do I strategically want to pay this year? Versus if we don't take advantage of that tax window, now all of a sudden we're forced to pay taxes when really we don't want to, we don't need the income, or now we're just along for the ride. RMDs started, we have Social Security income kicked in, and because we're over certain amounts, now we're paying Medicare penalties. And that's likely not going to go away unless you completely liquidate your 401k or IRA in a given year. So, tax lever number one, if you're looking at your tax window, let's say you have that 8-year tax window, we want to look at, okay, which levers make sense to pull. The one most people are familiar with are called Roth conversions. And that's the process of taking money from your 401k or traditional individual retirement account and converting that into a Roth IRA. Now, what happens in that conversion process is you're going to pay income tax on those funds, but the idea is we're going to get to take advantage of our current tax rate system, which, some believe that tax rates will go up in the future. Some believe that we're in a very low tax rate environment today, and so we're taking advantage of that. But also, as our income is lower, hopefully we're in a 10 or 12% tax bracket as opposed to a 32, 35, or 37% tax bracket. When we do this, we're also reducing the balance that's in these traditional retirement accounts, and therefore our required minimum distributions, once those start at 73, are going to be lower because that balance is lower at that time. And not to mention, once those funds go in the Roth IRA, they'll continue to grow invested and be tax-free permanently. So how Roth conversions work is we want to identify essentially how much taxable income that you'll have this year. And then we want to figure out, okay, at what point does it make sense to increase my income by doing a Roth conversion before it doesn't make sense? And so I'll give you the gist of after doing almost 700 retirement plans. I can tell you that very rarely does it make sense to go over this 22% tax bracket. And so if you're single, that's about $105,000 of income for 2026. If you're filing jointly with your spouse for taxes, that's about $211,000 of combined total income. So essentially, we want to identify, okay, how much taxable income do I have this year? And what would be the difference between this taxable income number and this 22% bracket? If I have another $25,000 that I can take as income before I jump to the 24% tax bracket, it might make sense to take that $20,000 to $25,000, convert it into a Roth account now, knowing I'm going to pay 22% tax on those funds on that conversion, but I'm reducing my RMDs in future years. I'm also increasing the amount of money that'll grow tax-free permanently, and I'm taking advantage of relatively low tax rate today. The great news is we can continue to do that every year of your tax window, and so that's why it's $20,000 might not seem like a lot if you have over $1 million in your 401k or IRA, but it's these little chunks taken over time that help with the grand scheme of things. Number two is a hidden gem, and it's one of my favorites. It's called capital gains harvesting. Capital gains harvesting is relevant if you have long-term capital gains holdings. So if you've held stocks or investments for more than a year, those, if you were to sell, now apply to the long-term capital gains tax brackets as opposed to the short-term or ordinary income tax brackets. It's a much lower tax rate. You can see at the bottom here, you have a 0% long-term capital gains window, and then 15%, and at the highest threshold, a 20% tax. When we combine that or compare that with the 39% highest ordinary income tax bracket, you're much better off trying to hold things that qualify for this long-term capital gains treatment. But the idea of harvesting capital gains is really to try and get in the 0% window, if at all possible, during your tax window. And so how would that happen? Essentially, if you have income under $49,000 filing single or under $98,000 filing jointly with your spouse, you can sell long-term capital gains positions and pay zero tax on those gains as long as it keeps your income under these thresholds here in this green box. Now, why would we do that? That essentially resets your cost basis. And so I'll walk through an example here on the next slide. But resetting your cost basis, again, is going to trigger that smaller tax today and allow you to have a lower tax down the road, as opposed to just continuing to kick this can down the road, have higher and higher gains, and then pay a bigger tax all at the end when you sell it years down the road. So what we're going to do is, again, identifying taxable income. You're going to see this as a recurring theme throughout our session today. Knowing your income and at least being able to project or estimate what your income will be is key for knowing which of these levers to pull. We want to identify the 0% threshold. So whether you're filing your taxes single or jointly with a spouse will determine what your 0% threshold is. And then, hey, if I can take advantage of it, does it make sense to realize some of those gains, to sell some of those appreciated investments at that 0% threshold and potentially reinvest if I don't need those funds right away? So walking through an example, here in this orange box, we have before harvesting. So there's an investment you paid $20,000 to buy into, and it's now worth $50,000, which means you have an unrealized gain of about $30,000 that investment has grown. So if you were to, sell all of that in the future, let's say you're in the 15% long-term capital gains bracket, you're going to owe a tax of about $4,500 federally. If you're in California, obviously you have California state income tax on top of that. Whereas if you did a capital gains harvest, let's say there were a few years that you were in the 0% long-term capital gains bracket, you, instead of having a cost basis of 20,000, you would actually have a cost basis of 50,000. Now, why is that? That's because we've been slowly realizing this $30,000 gain and keeping it at the 0% long-term capital gains bracket. And therefore, we don't have that $30,000 gain after we've done the harvesting year over year. Now we have a $50,000 investment. That's still the current value, but our cost basis is now also that $50,000, meaning if we need to sell that investment and use that $50,000 of proceeds for whatever case, we don't have any realized gains, and therefore we're not paying any tax at that point. So a hidden strategy, a lot of people talk about tax loss harvesting. This is essentially the opposite of, hey, let's take some gains if we have very low income years in your tax window. Tax lever number 3 is the Medicare IRMA thresholds. That stands for income related monthly adjustment amounts. So very few people know about this. And it's one of the tax grenades that can be very costly because these penalties do not go away unless you eventually show a lower income or have a qualifying event where we can readjust them after the fact. But you have to apply for that and hopefully get approved. So income related adjustments for Medicare, essentially, if we go over any of these income thresholds here, right now, the base amount that you're paying for Medicare Part B is $202 per month for 2026. If we go over $109,000 of income, or $218 if you're filing jointly, now we start to pay more for that same coverage. Here, again, it jumps to $284 per person. That's an $82 a month increase penalty just for going even $1 above this initial threshold. That number can continue to increase and moves quickly. So if you have income going over $130,000 or $275 filing jointly, now we've just spiked our Medicare premiums to $405 a month. I was recently working with a client who has been paying $689 a month for their Medicare coverage, and they just thought that was normal. they didn't realize that their financial advisor, when they had liquidated some of their holdings 2 years ago, that liquidation was enough to trigger them into the maximum Medicare premium amount. And so they were just planning on paying $689 a month permanently for Medicare. And we are able to eventually get them hopefully down to this $200 a month. It's a meaningful savings of almost $500 a month or $6,000 a year back into their pocket. Now, keep in mind, and I just alluded to it briefly, Medicare is looking at your income from 2 years ago. So for 2026, if you're applying for Medicare today, they're looking at your 2024 taxable income to determine what rate you will pay for your Medicare Part B and Part D premiums. So if you're retiring, also keep that in mind. If you had sizable income, right before you retired and you're currently on Medicare, or applying for Medicare, excuse me, then the then you're likely to pay more than what your retirement income might look like, right? If you earned $400,000 the last couple of years working right before you retire, and then you're going to go retire, you're going to apply for Medicare, your income's going to be much lower in retirement, and you get this Medicare bill of $600 a month, and you're thinking, why do I have to pay $600 a month? I don't make nearly what I used to make working, and it's because there's a 2 year look back. And so if that applies to you, and if you're retiring, and if you will have a lower income in retirement, you can file what's called an SSA 44. And that is essentially a form that you will submit to the IRS stating why you had a change of income. Usually you can point to retirement, what your projected income will be going forward. And that's an application to get your Medicare premiums lowered to the correct amount going forward. But again, that's an application process, takes time to hear back. But in many cases, as long as the facts are consistent, you can get approved for that lower Medicare charges. So with that said, here's a brief example. Again, know your IRMAA threshold. So that's on this screen here. So whether you're single or married filing jointly, pay attention to that table. And then we want to estimate your future income. So we're going to look at what's Social Security, what are my RMDs going to be when those turn on at 73, and how much am I taking from other investment accounts, whether those are tax deferred or taxable. And then we want to see, okay, at what point, is there any point in my retirement journey that my income will start to go over those Medicare premium brackets? And again, they adjust every year for inflation, so they will go up slightly, but we want to be very, very mindful of, hey, if I'm filing jointly with my spouse, anything that's eventually going to kick us over $218,000 of income will trigger that first Medicare cliff or penalty. And so finding ways to stay under that throughout retirement or staying under your next IRMAA threshold will be key. All right, tax lever number 4, Social Security. Now, for most of you, there's not much that we can do about this because your income has to be fairly low for Social Security to not be fully taxed. But at the highest end, up to 85% of your Social Security benefit can be subject to income tax. So if you're filing single, that's about $34,000 of income for 2026. If you're filing jointly, that's about $44,000 of income. So again, very low numbers. But you want to be mindful that it's based on provisional income, not just Social Security alone. And so that provisional income is essentially your total income plus any tax-exempt interest. So if you have, treasury bonds, municipal bonds, things like that, plus 50% of your Social Security benefit. So any withdrawals that you're taking from any of your accounts do count and add towards that provisional income. The only thing that would not count and increase your provisional income is a distribution from your Roth account. which is why we love filling up that Roth bucket. Tax lever number five, I've talked about this one the most so far, but that's required minimum distributions. Most pre-retirees that I work with fail to realize how much their 401ks and IRAs will compound to over time by the time they reach age 73, or by the time RMDs begin. And so the RMD amount that you have to take is the same for everybody, but it's a percentage. So, and don't quote me on it because this number is always very specific and changes year to year. It's about 4% for the initial year. And then every year after age 73, that percentage goes up. And so you're having to take more and more withdrawals from your qualified accounts or your tax deferred accounts over time. Now, if you have a very large IRA balance or 401k, it's looking at what all of your qualified accounts, your tax deferred accounts, that entire balance is at the end of the previous year. And then your RMD applies to that number. And you have to take a minimum distribution of, let's call it 4% from that total number from at least one of your accounts. Sometimes we take it from each account. And that's whether you need the money or not. And so you're forced to pay tax on those. And this is the biggest killer of not just increasing taxable income, but putting you into Medicare penalties and also increasing the taxation of your Social Security benefits. So what we like to do is we want to try and estimate what your RMD will be at age 73, no matter what age you are now. We want to look at, okay, when are you planning to retire? When do your RMDs begin? And if we forecast what your qualified accounts will grow to at that point, we can actually estimate what your RMDs will be at that time. Then we compare that to today's income. Okay, what bracket are you in today? What bracket will you be in the future? And would it make sense to take some distributions from your IRAs now or do Roth conversions? You know, you don't always have to do a Roth conversion. Some individuals, if you're planning to retire, you're needing some income to supplement, carry you through retirement. And so maybe it's just a matter of taking that income from your IRAs and 401ks now, as opposed to converting them into Roth. And so you can see here, you know, this red line here is essentially a pre-retiree's income if they're not doing that taking advantage of the tax window. So we go to retire, our income is lowest, but then you can see it spike up here because RMDs started and we just let those 401ks and those IRAs keep growing without doing anything about it. Whereas if we take a more proactive approach, yes, we are claiming a little bit more income in these initial years of retirement, but the reason we're doing that is because it's actually going to lower our taxes for the rest of our lives after 73, and that is by a significant amount. And so we always say taxes are not a 1 year at a time problem. You want to build a tax strategy that looks at the rest of your life, or at least the next 10, 20 years, so that we can see, okay, how do I pay the least amount of lifetime taxes, not just in any one given year? Okay, the last tax lever that we like to use is charitable giving. And this is a great tax strategy for those that have additional income that you're trying to get deductions for. And there's a few different ways to do it as far as contributing to charitable causes. One is qualified charitable distributions. These are relevant. I believe you have to be 70 and a half to make a qualified charitable distribution. And this is where you basically make a charitable distribution directly from your IRA. So that tax deferred account, that qualified account, let's say you have $1 million in there, and you have to pay RMDs or take RMDs. Instead of taking those RMDs or to offset some of those RMDs, you can essentially elect a qualified charitable distribution where you send up to $100,000. Actually, it's up to $111,000 for this year, directly to a charity of your choice. And that counts, that satisfies your required minimum distribution up to 111,000 of it. And it's also a non-taxable event because you've donated it to charity. So you're not paying income taxes on that amount. Now, some say, okay, do I get the tax deduction for contributing to charity? And unfortunately, you do not. That is why it's a tax-free contribution to the charity at that point. But still helps lower your taxable income, just like we designed, and helps take a chunk out of your RMDs if RMDs are relevant for you at that point. Charitable giving strategy number 2 is a donor advised fund. This does not satisfy RMDs, but it does lower your taxable income for a given year. And so essentially that is moving money from, your left pocket into your right pocket, into what would be a donor advised fund. You get a tax deduction right away for funding that donor advised fund, but you don't have to contribute those funds to charity in that same year. You can allow the funds to sit there in that donor advised fund and then give to charities of your choosing at some point in the future. It allows you to continue investing those assets. You're not owing taxes on those. The only requirement is those funds, once you donate them to a donor advised fund, they have to go to a charitable cause. The other option that you can do, if you do decide to make those charitable contributions all in that one year, is just bunching your deductions. And so that would say, like, hey, instead of donating $10,000 a year to charity for the next 5 years, especially if you're not itemizing on your tax return, what we might choose to do is take those 5 years of $10,000 contributions, so $50,000, and just make that $50,000 charitable contributions in 1 year. What is that going to allow us to do? That allows us to minimize deduction this year for that $50,000. We capture the tax deduction for that full $50,000 amount. And then over the next 4 years, when we're not making those charitable contributions, we can benefit from this higher standard deduction, which is about $32,000, $33,000 for this year, and not have to worry about making charitable contributions to try and lower our taxable income. We did that all in 1 year. So it's essentially we're pooling those $10,000 annual gifts into 1 year to increase our taxable benefit strategically. Now, here's just a couple case studies of how we use this tax window for those planning to retire. In this case here, we have Maria. Maria was adamant to retire at age 62. Her IRA balance, so her 401k rolled into an individual retirement account, was $800,000 at the time. And as much as Maria hated the idea, we convinced her to not take Social Security right away, knowing that, hey, we're going to have to live off your investment account, that IRA, for an initial period. But in the long run, it's going to be an extreme benefit to your retirement. And so the idea of someone living totally off their investments when they go to retire, it is such a drastic change from, hey, I get paid every 2 weeks, to, wait, now I'm living off these investments and I don't feel like I have enough money. But when you can see how the total plan is working over a 30-year period, you can see the benefit of this. The other thing that we had to do, because she was retiring at 62 and not eligible for Medicare yet, we had to find Affordable Care Act health insurance that hopefully didn't cost her an arm and a leg. So showing that lower income until she qualified for Medicare was also beneficial here. So what we did was we had her live off her individual retirement account to cover lifestyle expenses. And then we were also still able to convert additional funds into a Roth that got her up to that 12% tax bracket. This also helped keep her premiums low because she was able to qualify for subsidies through the Affordable Care Act to lower her health insurance costs, which was a huge benefit to a successful retirement for her. So, what that resulted in was a lifetime tax savings of over $85,000. And her required minimum distribution at 73 is 42% lower than it would have been had she not made any of these changes. Okay. She qualified for about $28,000 in Affordable Care Act subsidies that covered a lot of her health insurance premiums until she qualified for Medicare. And her tax bracket now, even with RMDs on, is 12% instead of 22%. That's a 10% tax savings for the rest of her life. That was huge. Now, we have a case study here that wasn't as beneficial. This was Bill. Bill was also 62, planning to retire, but he did not like the idea of living off his individual retirement account. He even had more in his IRA than Maria did. He had about 1.2 million. He did not want to do any Roth conversions. He did not want to live off this balance simply because he didn't want to pay tax. But he failed to see the longer term lifetime tax window. And so the other piece was he still wanted income coming in because, again, used to receiving monthly paychecks. And so he elected to take his Social Security at age 62, something we normally frown upon. And here we'll see why. So he let this $1.2 million IRA continue to grow without doing any Roth conversions or without taking income from it. Then when his RMDs start, they will push him above the 22% tax bracket. Not only that, now that he's earning that much income to put him at 22%, he's also triggered Medicare penalties once those RMDs begin. And so instead of an $85,000 tax savings like Maria, he's actually incurred a $90,000 tax penalty. Once RMDs begin, he'll be in that 22 to 24% tax bracket, depending on the growth of his IRA. And here's the kicker. His Medicare premiums went up that $700 a month for the rest of his retirement. So that's $8,000 a year for the next 20, 30 years, however long he continues to live. That is a sizable penalty for not wanting to pay taxes from age 62 to age 73. So you can see here over a six-figure tax penalty when everything, when push comes to shove, when RMDs trigger. And this is why using this tax window and using tax planning is so critical if you're planning to retire. So what we put together is a self-assessment, and I also have my tax checklist that I want to share with each of you as promised for being with us here today. So let me figure out how I'm going to add this to the chat. But what this self-assessment is at least going to let us do, let me see here to everyone. I'm doing two things at once, adding the attachment here. Okay. What this is going to allow us to do is, of course, that froze. Bingo. Okay. Just uploaded that to the chat so you have that retirement tax checklist. That is in addition to this quick self-assessment. And so we use this self-assessment to say, okay, do you know what your RMD will be at age 73? Do you know if it makes sense to do Roth conversions between now and when those RMDs start? How is your tax diversification? So if we look at, okay, how much of your retirement assets are in tax deferred accounts, those 401ks and IRAs, how much is in taxable, trust accounts, individual brokerage accounts, joint accounts, things like that, and how much is in tax-free Roth IRAs, et cetera, Roth 401ks. We want to make sure we're diversified across those three tax buckets. And then do you know your Medicare income thresholds to be aware of? Do you know how your Social Security will be taxed? And do you have a rough idea of what your income will look like for the next 5 or 10 years? Those are the key questions to be answering if you're planning to retire in the next, 6 months, 24 months, 36 months, etc. What I'll walk through real quick is our retirement tax checklist that I just uploaded to the chat. And so why this is beneficial is it's really going to help us analyze, hey, which of these tax levers should I pull? And so you'll go through here, you'll jot down your retirement date, your estimated required minimum distribution date. Again, your date of birth will determine if it's 73 or age 75. And then between those two dates, that becomes your tax window, exactly like we've been talking about. So then you want to say, okay, what is my future tax exposure? How much do I have in my IRAs and 401ks? How much do I have in my Roth accounts? How much do I have in my taxable accounts? And then what other income sources will I have coming in? Do I have a pension? Do I have Social Security? Do I have rental income, investment income, etc.? That will allow us to look at this first tax lever of, hey, does it make sense to do any of these Roth conversions? And then we have a checklist there. Is there any way I will benefit or qualify for capital gain harvesting? And so this outlines our 0% long-term capital gains tax bracket system. Do I know what those RMDs might look like at age 73 or age 75? So we're going to forecast, hey, based on how my IRAs are growing, am I projecting a 6 to 10% annual return? And if I apply that to my IRAs and 401ks, what would be my first year RMD based on that amount of growth? And then when am I taking Social Security? If I'm going to have Social Security turned on early, how is that affecting my tax window? And then lastly, um, what are my Medicare penalties to be aware of? Do I know my Medicare income brackets and how I'm going to make sure I stay under those amounts? And then here's just putting the entire tax strategy together. And so all of these will basically help you see or identify any of those tax traps or opportunities to take advantage of in retirement and in that tax window. So this is the tax checklist that I just uploaded to the chat. Different way, I walked you through the full thing so we know all of the moving pieces there. There's ways that we're happy to help you. One, that checklist that I shared, I want everybody to use that. It's completely free. That's at your disposal. Reach out to me if you're watching the recording and you would like a copy of that checklist. I will put my email address here in the chat in case you need to request a copy. The other thing that I will add here is I don't have access to right now. Let me see. Is our retirement tax diagnostic. So this is essentially an express version of our financial planning system. And what it allows you to do is it allows you to, of course, moved it over here, excuse me. It allows you to build out your own scenario of to project your income and RMDs and things like that. It's basically a tool instead of using, a traditional piece of paper or a Microsoft Excel. You can use our financial planning tool. Again, it's an express version, so it's not the same comprehensive plan that we would build out for you, but at least it gives you answers and it makes it much more easy to do it yourself. Then we have the comprehensive planning. Unfortunately, I'm not personally taking on new clients at this point, but you can join the wait list to work with me. There's other advisors on our team that would be happy to help you. So if you would like a more comprehensive plan built for you, please don't hesitate to reach out. We would be happy to help you there. And with that said, that covers our retirement tax window. Just remember, returns are important, but looking at taxes planning taxes appropriately can be far more beneficial than earning an extra, 2, 5% in the stock market or in your investments. So make sure you know when your retirement tax window exists. Make sure you use it intentionally because that window will permanently close when RMDs begin. I hope you're walking away from this session with a couple additional things that you can take into consideration as you plan retirement. I hope you've found value in joining us today, and I thank you very much for being here. Have a great rest of your day.